Thanks for joining us today. I'm really excited to talk to you about digital capital and digital credit. So let's go to the first slide. The first point that I want to make is that Bitcoin has emerged as digital capital. What is digital capital? Digital gold. Capital is a long-term store of value. Bitcoin is a store of value. The U.S. government has embraced Bitcoin as a store of value, and that means every major cabinet member, and I'm showing them here. And of course, the decision that America is going to be the Bitcoin superpower is an endorsement, along with the president's point that you don't ever sell your Bitcoin. Let's go to the next slide. Wall Street has embraced Bitcoin as digital capital. Now you've got 1.5 million Bitcoin held by the spot ETFs, about $170 billion worth. The most successful ETF in the history of Wall Street is IBIT. And IBIT has explosively grown even in the past few months. The daily liquidity in IBIT is now approaching $4 billion or more a day. Open interest in IBIT has gone to more than $50 billion in open interest. And so this is wildly successful. Next. Public companies have embraced Bitcoin as digital capital. We were the first public holder of Bitcoin. Then there were 2, then there were 4. About a year ago, there were 60. Now there are 200 plus publicly listed companies holding Bitcoin. That's more than 1 million Bitcoin, and it's about 116 billion in value. I've got a few metrics here on this slide that show just the scale of the Bitcoin market. It's a $2.3 trillion market cap. It's $58 billion of daily liquidity, $76 billion in BTC open interest in the derivatives market, and it's backed by 26 gigawatts of power. That's 26 full-on nuclear reactors. It's and the hash rate keeps going up. We're now up to 1,100 exahash. And you have 30% of all voters in the United States that are registered, of the registered voters that are crypto holders. The industry crypto is 3.9 trillion, and there's 700 million crypto users, and of course 300 million Bitcoin holders. So this is a global movement at this point. Bitcoin is the capital asset at the center of the entire crypto industry. And it is traded on 1,000 exchanges. Next. Now, what do you do with digital gold? Well, what do you do with gold? You issue credit on gold. For 300 years, the Western world ran on gold-backed credit. Bitcoin is digital gold. What we've realized is that the killer application of digital capital is digital credit. And Strategy enables a wide variety of securities based on that digital capital. What you can see here is that the baseline is IBIT. IBIT is digital capital in a ETF wrapper. And it's got a 53% annual, a 53% return on average for the past 5 years. And the volatility is 38% right now. Now, what we have done is created 4 digital credit instruments that strip the volatility and extract or distill the performance out of IBIT. So Strike's volatility is 28, and it gives you a 9% effective yield and some upside. Stride's volatility is 16. It gives you a 13% effective yield. Strife's volatility is 14, and we extracted a 9% effective yield. And of course, what we're doing is we're extracting a certain type of risk, or we're mitigating, stripping off a bunch of risk. We're extracting a yield. We're damping the volatility. And the largest piece, or the greatest piece of financial engineering we've performed, is Stretch, which has converted that 38% volatility into 8 and extracted that effective yield of 10%. And of course, as you can see, since we damped the volatility, there is sort of a conservation of energy or a conservation of volatility in the thermodynamic universe. And so where does the volatility go? it goes to the equity. So the volatility that we strip off of BTC accrues to MSTR. And of course, the performance and the opportunity that we strip off of BTC also accrues to MSTR. So what you see here is a fairly straightforward financial engineering exercise. We are a structured finance company, and we are starting with a blob of high energy capital, long duration, highly volatile, high performance. We are engineering out different durations, different volatilities, different risk profiles, different performance profiles. We're even transforming it from the BTC currency into the USD or to different currencies, and that is the exercise. Next. Now, this chart shows the economic landscape we work in. Here you see Bitcoin's performance of 53% over 5 years. Almost double the Mag 7. You can see gold performed 15% a year. It's slightly edged out the S&P at 14%. S&P is the conventional cost of capital. Real estate is underperforming the S&P dramatically in this time frame, only up 6% a year. Money market instruments, those short duration treasuries in the US, on average have provided 3% performance a year. And mid-dated to long-dated bonds are -3. Strategies equity is +83. And of course, all of our financial engineering is based upon taking advantage of a lower cost of equity and a lower cost of credit, and then using that in order to acquire Bitcoin, which then accrues to the benefit of the equity holders. Let's go to the next slide. So let's look at our products. Strike. Strike is structured Bitcoin. It's convertible preferred, so it has some upside via the equity component. 33% of Strike is equity. It has some dividend, an 8% dividend at par, right now an effective yield of 9.1%. And then Strike pays ROC dividends, which means they're tax deferred as you step down your basis. And so the tax equivalent adjusted yield is 21.6%. How do you get to that? Well, you take the cost of Strike, you subtract the equity component, and then you look at the effective yield of the remainder, and then you look at the tax adjusted effective yield, and you end up getting to 21.6%. So this is a misunderstood security, but it's got very compelling offers, because on one hand, it's an indefinite, a perpetual duration call option on the stock, and it's also a perpetual dividend. So if you're a very long-term investor that wants the best of both worlds, some upside, some income, and if you want risk stripped away, well, we've got a BTC rating of 5.2, which means that Bitcoin could fall by 80% and you would still be over collateralized. You know, if you bought Bitcoin and it fell by 80%, you lose 80% of your money. If you buy this and Bitcoin falls by 80%, you still keep your money, right? It's a principal protection. And so down here at the bottom, I've got a table, and you can see, you know, the effective yield of the things that Strike competes against are 1 to 4%. And so this is a very unique thing. And it's really, it's higher yield, more upside, longer duration than alternative investments. And let's go to the next slide. Stride is our second credit instrument. This is long duration, high yield credit. The effective yield is 12.5%. That makes the tax equivalent yield nearly 20%, 19.9%. It's still 4.8 times over collateralized, so Bitcoin can still fall by 75%. You're still over collateralized. And it's got a duration of 8 years, which is a Macaulay duration, but really what you're getting is you're getting the 10% dividend at par perpetually, forever. And so if you compare it to the universe it competes against, the effective yield on most high yield corporate bonds is 6%, and they're taxable. 6.2%. Leverage loans are 6.8%. They're taxable as normal income. Preferred stock ETF, 6.2%, emerging market debt, 5.6%. So the effective yield of Stride is double, but the tax equivalent yield of Stride is triple. And so you get triple tax equivalent yield with more collateral coverage. This, again, is a misunderstood instrument, but if you're seeking maximum cash flows, right, and if you trust Bitcoin minimally and you trust the company, then this is a very interesting opportunity for you. The next instrument is Strife, STRF. Well, that's long duration senior credit. It's cumulative and it's got more protections because there are penalties if the company were ever to suspend a dividend, and it's also more highly collateralized. The BTC rating is 7.5. So $7.50 of Bitcoin for every dollar of Strife outstanding. The effective yield is 9.1% because it trades above par. And the tax equivalent yield is 14.4%. So when you look at this against comparable assets, the effective yield is double, the tax equivalent yield is triple, and the collateral coverage is 2 to 3x more. This has got a duration of 11 years, and so longer duration. What that means is that if interest rates move up or move down, there's going to be more volatility on this. If you believe interest rates are going to dive, then this is a great thing. You would like a long duration instrument. If you believe that interest rates are going to go up, then that would be the opposite. You probably wouldn't. Now let's go on to Stretch. Stretch is the highest degree of financial engineering we've engaged in. Because with Stretch, our goal was to strip the volatility, compress the duration, convert the BTC into a pure USD yield, and then offer that to the investor. So right now, Stretch is 10.4% effective yield, but that's a tax equivalent yield of 16%. It's just slightly under 6 times over collateralized. And of course, it's the lowest volatility. Our goal with Stretch is, we want to give everybody something that's comparable, something that's competitive with a money market that pays you 10.4% that is tax deferred. If you walk down the street and you say to someone, do you want a convertible bond? Not sure. Do you want a 20-year crypto bond? Not sure. Do you want a crypto junk bond? Not sure. Would you like a bank account that pays you 10% tax deferred? Yeah. Everybody wants a bank account that pays them 10% tax deferred, right? Why wouldn't you, right? And so this is, to be clear, it's not a bank account. It's not even a money market, but we are structuring it to compete with that source of funds. That's what we call it, treasury credit. It's for corporate treasurers. It's for your family treasury. It's the money that you probably need to spend in the next 12, 24, 36 months. If you didn't need the money for 4 years or more, I would say, you probably ought to go look at buying Bitcoin. If you don't need the money for a decade, you buy Bitcoin. It's a better deal. But if you need the money in 4 months or 8 months or 2 years, or you have 30% of your working capital that's stable, that's a treasury obligation. And right now, your options aren't great. So here we're offering 10.4% effective yield, but 16% tax equivalent yield. If you look at bank accounts, they yield nothing. Money markets are 4% in the US. So this is 4 times better, 4x better than the tax equivalent yield of a money market. Now you'll note it's more volatile, right? The money markets managed to get down to less than 1% or about approximately 1% volatility. We're still 8% volatility, and I think that's in some part because we're still seasoning, and so we are going to continue to work to get this volatility down below 8 to 7 to 6. We got to 5%, about a week ago. We don't know how low we can get it, but our goal is to make it the least volatile of our credit instruments. Let's go to the next slide. Fong spoke about return of capital. The point that I want to make is ROC dividends have been around. This is settled tax law since 1910. Return of capital has been around since 1910. You'll find hundreds of companies that have issued dividends that are return of capital. You'll find oil pipelines, natural gas companies, real estate companies, etc. We just happen to have a very compelling business model. The treasury business model allows us to have much greater visibility to return of capital than if you were just a REIT or you were a gas pipeline or something. And so the difference really is 0% upfront dividend tax rate versus 20 to 30 or 30 to 55. And if you got your money in a money market and you live in California or in New York City, it's a pretty heavy tax load. And so presumably New Yorkers or San Francisco dwellers, when they start to look at this, are going to find it to be pretty compelling. The fact that we expect this to continue for the next 10 years means that we're not just announcing that this quarter is a return of capital. We're expecting the next 40 quarters to be return of capital. And I think that's a pretty material thing. Let's go to the next slide. Now, all of those credit instruments have one impact. They amplify our Bitcoin exposure. So right now, Strategy has 11% leverage, 21% amplification. Okay, amplification is the leverage that comes from debt plus the improved performance that comes from equity. Our goal, our target as a company is to drive leverage to zero. When we equitize the convertible bonds, and if we don't issue any more bonds, and we don't intend to, leverage will go from 11% to 9% to 7 to 5 to 3 to 1 to 0. So our leverage is going to zero. Our target for amplification is to drive the amplification to 30%. So we're going to drive amplification up and drive leverage down. And of course, here you can see on this chart, if we run at a 30% amplification level, what naturally happens is your 200,000 Satoshis per share become 560,000 Satoshis per share over 10 years. That's a BTC factor of 2.8. That means that we actually perform 2.8 times better than an ETF. That is the source of the premium in the equity. That is the value that's being created by the digital treasury model. And of course, the value creation is a function of the amplification. When you increase leverage, you increase risk. But when you increase amplification, you just increase value creation. So if we get to 30% amplification, then we may very well go to 35 or 40% amplification because we're doing it with digital credit, and digital credit doesn't have the risk profile of debt. Let's go to the next slide. We are at a historic point. We're kind of at an inflection point, we believe. Our multiple to NAV, MNAV, has been trending down and has been trending down over time as the Bitcoin asset class matures, as the volatility decreases. The volatility, by the way, is decreasing in part because of the growth of companies like ours, the maturation of the Bitcoin treasury industry. It's decreasing because of the success of IBIT. It's decreasing because the derivatives market onshore has grown dramatically. The derivatives market in IBIT has gone from 10 billion to 50 billion. And so people are using those derivatives to damp volatility, and that's very good for the asset class. It's very good for the industry. In the near term, it's resulted probably in some pressure on our MNAV, but we think that over time, as the credit investors start to understand the appeal of digital credit, they're going to want to buy more, and we're going to sell more and issue more credit. And as the equity investors start to appreciate the uniqueness of the Bitcoin treasury model, and especially the uniqueness of our company and our ability to issue digital credit worldwide at scale, we think that that's going to drive an appreciation of the equity. Next slide. Why am I so enthusiastic about digital credit? Well, there are 7 innovations in digital credit that make it better than traditional credit. So I'm going to take you through the 7 things. First of all, traditional credit, like a mortgage, well, it's built on a depreciating house or a depreciating warehouse. Or traditional credit, it's built on collateral that's a depreciating asset, a bunch of fiat currency, a corporate product, a corporate service, a corporate warehouse, a bunch of hardware, a data center full of NVIDIA chips that are depreciating with a 4-year useful life. That is collateral which is collapsing. It makes it hard to pay a higher yield when you have depreciating asset. But our collateral is Bitcoin, it's digital capital, and Bitcoin is an appreciating asset. So whereas $10 billion of warehouses are most valuable the day they're built, $10 billion of Bitcoin is only going to get more valuable, not less valuable. And so that digital capital is the first big innovation. Next, the second innovation is we're replacing traditional risk with digital risk. Traditional risk, it's opaque, it's heterogeneous, it's discrete. You own 8,700 houses, or you own, you're exposed to a portfolio of 47 junk bond issuers. And maybe they're fine, but then there's a tariff, or there's a trade war, or there's a competitive change. Or maybe there's a strike, or maybe an airplane crashes, or there's a COVID lockdown. Whenever you have these kind of conventional real world issues, you have a discrete explosion of risk, a forest fire, an earthquake, or a change in a political regime, or a change in tax rates, or a change in customs duties. So traditional risk is opaque, it's heterogeneous, it's discrete. On the other hand, digital risk is transparent, it's homogeneous, it's continuous. You can go to our website and we update the risk model every 15 seconds. And so it is completely continuous. We update the price of Bitcoin. We update the volatility of Bitcoin on a continuous basis. We update the BTC ratings. You can plug in your statistical models into them. And of course, all the risk is based upon your outlook of BTC ARR, BTC vol, BTC price, and BTC rating. So digital risk is something where you don't have to wait for a year for a credit rating agency to publish a new report to tell you whether your favorite airline or your favorite, restaurant chain is riskier or less risky. With digital risk, you can literally plug into the website and you can recalibrate and calculate your risk every 15 seconds on Saturday morning. And that's a big upgrade. Now, there's a third innovation in digital credit. Our third innovation is all credit is not created equal. We don't just issue debt. Debt is credit. Bank deposits are credit. When a bank takes your money, they're creating credit, and your bank account pays you whatever they pay you. When you put money in a money market, it's credit. Of course, junk bonds, sovereign debt, mortgage-backed bonds, they're credit, but they're debt. And debt and deposits are liabilities. They amplify risk. If there's a run on the bank, people withdraw their deposits, right? You're going to have a collapse of the entire banking system. When the debt comes due, when your 3-year note comes due, when you get to month 34, everybody goes crazy and loses their mind because the capital is getting called away from you, right? If you have a bad quarter in the 12th quarter and you've got 4-year debt, you amplify risk. The equity collapses, people go crazy. What we've done is use preferred equity. It's not debt. Sometimes people think, okay, well, it's a liability. It's equity. It's actually counted as preferred equity is equity on the balance sheet. It's not debt. It's an asset, not a liability. And so therefore, it mitigates risk. How does it mitigate risk? Well, I mean, the first obvious way it mitigates risk is when you sell $1 billion of bonds, you have to pay them back in 5 years or 7 years or 3 years. when you sell $1 billion of preferred stock, you never pay it back. So there's $1 billion of refinance risk that just goes away. The second way that it mitigates risk is that the dividends are approved by the board. They're not coupons. You miss $1 million of coupon payments, you're in default. Whereas if you're short $1 million, of a dividend payment, you can suspend $1 million. You're not in default. So you could think about preferred equity is permanent capital and shock absorbers to the business model of the company, and therefore digital credit based on preferred equity is dramatically better than digital credit or credit that's based upon debt or deposits. The fourth innovation is, we didn't just issue preferred equity. We issued perpetual preferred equity. Sometimes banks or issuers issue equity which has got a 3-year life or a 5-year life or a refinance option or a call option or a put option. That creates some sort of refinance risk or withdrawal risk. But when you have a perpetual equity, it is permanent capital, right? Your bank might have $100 billion that's overnight money. Someone can take the $100 billion away from them. You have $100 billion of debt at your airline. It's going to be taken away from you in 3 to 5 years. When we have $100 billion of preferred equity, we have it forever, like forever, 1,000 years. It just goes on and on and on. Perpetual life. When you have permanent capital, you can make indefinite investments. We can buy Bitcoin to hold for 100 years if we have capital for 100 years. When you have a 5-year junk bond, you can't make a decision that's going to, and the truth is you have to have decisions that are no longer than like 2 or 3 years because you have to keep rolling them because of the refinance and the withdrawal risk. So the perpetual life of the instruments is the fourth big innovation. The fifth big innovation is that we took these securities public. This is public credit. A lot of times people sell their credit instruments via 144A offerings to a private market. It's like I sold it to 50 investors and they're traded over the counter. Those are illiquid. They're unbranded. Can anybody name the 17th tranche of bank credit sold by, one of the large banks in the US? They have CUSIP numbers. They're traded on Bloomberg's between 37 counterparties, and they all know each other. So it's unbranded, it's illiquid, it's local, it's very difficult to buy it. Even if you wanted to buy it, you would need a professional money manager to even find it for you or buy it for you. When you do, there would be 300 basis point credits or bid-ask spreads. Very big spreads. The thing traded last 2 weeks ago. That's the problem with private credit. Public credit, like STRC, it's liquid. I mean, it traded nearly $100 million today in the market. It's branded. It's got a name, Stretch. It's global. You can buy it if you're in the UK from your retirement account. It's easy to access. You can buy it on Robinhood. You can buy it on Schwab. And so public securities become public brands. And if you're going to buy a credit instrument, what would you rather have? A credit instrument that's traded by 12 funds in Italy that know each other? Or would you rather have a credit instrument that's held by tens or hundreds of thousands of investors worldwide that all refer to it by the name Stretch? And if it ever gets mispriced or it gets undervalued, they're going to leap in and they're going to put lots of money behind it. When we did the IPO of Stretch, we priced it at 90. We said we're targeting par 100. There were individual investors that bought $250 million of that instrument. $250 million, right? The value of a public security, a public credit instrument, is if someone goes wacky crazy and decides they want to misprice it, there are people that will walk in and they'll buy 50 million or 100 million or 500 million to fix the market because they can. That does not happen in private credit markets. And so public branded global securities are just better. Let's go to the next innovation. Digital creation. Ask yourself, how long does it take for a bank to create $1 billion worth of home mortgages? How long does it take to issue 1,000 $1 million loans? It's very difficult. It's slow, it's expensive, it's labor intensive. So the creation of traditional credit is very hard. The reason that you have banks with 37-floor buildings that have 27,000 people in them is because the creation of credit is expensive and difficult. On the other hand, we can create $1 million of credit, $10 million of credit, $100 million of credit, or $1 billion of credit in 60 seconds on any given trading day. It's all automated, it's efficient, it's instant. So digital creation makes this completely scalable, right? We have a very scalable business model, and you can understand why if someone wanted to buy $10 billion of commercial credit backed by airplanes, it's kind of hard to create the airplanes to back the $10 billion. You can't just create the airplanes in 60 seconds. But we can buy $10 billion of Bitcoin to back $10 billion of digital credit, and we can do it contemporaneous with the demand. So that's the sixth advantage of digital credit. Let's go to the last point. The last point is traditional credit is taxable, whether it's fully taxable as a debt instrument or it's partially taxable as qualified dividend. Digital credit is tax-deferred income, right? We pay ROC dividends. We pay ROC dividends because of the business model, because we have digital capital as the underlying asset, because we have a digital treasury company and a digital treasury company business model. We pay ROC dividends, and ROC dividends are a profound competitive advantage for the credit issuer and for the credit investor. Let's go on. Next slide. Here you can see the value of the Bitcoin treasury model. We have created a flywheel. It's a scalable, tax-efficient, fixed income generator. You issue digital equity and digital credit that's tax-deferred. We pay dividends on that credit. They're tax-deferred. We purchase Bitcoin with those proceeds, and we hold it indefinitely. That's tax-deferred. Right? So it's a triple tax-deferred business model, scalable, new, never been seen in the history of the capital markets. That's why it'll take people a while to get their head around it, but it really is a beautiful instrument once you understand it. Let's go to the next slide. This digital treasury model allows us to create a digital credit factory. If you look at the company, what we're doing is we're manufacturing USD yield for credit investors, and we're delivering them that yield in the form of ROC dividends. So we're generating tax-deferred dividend yields in USD, and they're giving us capital. We are then buying Bitcoin with that capital. So we are funding the crypto economy. So the crypto economy is the 750 million people that are growing by millions every day that believe in pure global finance, and they're engaged in everything under the sun in 1,000 exchanges. So we fund that economy, and they return to us Bitcoin, and Bitcoin is 1/21 millionth of all of the capital in that economy. And so the credit investors get their yield, we get our Bitcoin, and then we're shipping and delivering BTC yield to the equity investors. So the equity investors want to outperform Bitcoin, and so the equity investors get amplified BTC exposure, which you can quantify via BTC yield. The credit investors, they get their USD yield. The equity investors, they're getting tax-deferred growth. The credit investors get tax-deferred dividends. It all creates a very powerful feedback loop. And, our long-term forecast is Bitcoin outperforms the S&P. I expect it'll go up 30% over a year for the next 20 years. So we're generating BTC NAV growth, and we're generating operating income, and that is tax deferred. And so it's a very powerful business model once you understand it. Let's go to the next slide. If you want to quantify ROC dividends a little bit better, if you actually have a $100 instrument, a $100 credit instrument that pays you 10% at par, if you reinvest those dividends every quarter, and it's a taxable dividend, or it's a taxable coupon at 37% tax rate, and that's what a bond would be, or a money market, or a corporate bond, or a junk bond, you're going to have $187 at the end of the 10 years. If you get that payment in a qualified dividend and you pay a 20% tax rate, you're going to have $221 at the end of the 10 years, so it's 18% more. And of course, if you receive those dividends as ROC dividends and reinvest the ROC dividends every quarter for 10 years, you're going to end up with $269 at the end of the period, and that's 44% more. So clearly, ROC dividends are compelling for the investor, and they get more compelling as you live in a higher tax jurisdiction. And as the tax rates go up, they get even more compelling. Let's go to the next slide. So digital credit opportunities, how do you break this down? Next. This is Stretch versus every other credit instrument in the United States on average. What you can see is Stretch is offering 16.5% tax equivalent yield. The hottest thing in traditional credit is private credit. It's 7.6%. Investment grade bonds 4.7, money markets 4.1, commercial paper 3.9, your bank account 40 basis points. So what you can see is Stretch is offering more than double, anything in the traditional credit market, but it looks sort of like 4 times better in the US. Let's think about all the digital credit instruments. What you see here is that digital credit is simply superior to conventional credit. Like the worst instrument or the lowest yielding instrument we have, STRF, Strife, it's got a tax equivalent yield of 14.4. It's double the best thing in the traditional credit market. Stretch is quadruple. Stride is 5 times, what you'll get from a money market. And Strike is even higher after you adjust for the equity component. So you can see these numbers are off the charts, and it's going to take a while for credit investors and for the market in general to adjust and digest this. But we believe that digital credit is the killer app of digital capital. And we believe that the most compelling business model is a digital treasury company built on digital capital issuing digital credit. And this chart shows you why. Now, this is the US. The US has the highest risk-free rates in the Western world. So let's look at the next chart. What I'm showing you here is the stretch rate. It's our short duration, sort of 1 month adjusting credit instrument versus the 1 month rate for the US dollar. And then let's look at, at the currency in Australia. It's 3.5%. Canadian 1 month rate is 2.7%. Korean won 2.5. European 1.9 and falling. Singapore 1.4, JPY, the yen is 50 basis points, and the Swiss franc is negative. So what you might take away from this is that we have an opportunity, not just in the US, but in the Middle East, in Great Britain, in Australia, in Canada, in Korea, and everywhere in Europe, in Singapore, in Japan, and in Switzerland. And we're studying each of these markets, and we're thinking very hard because we can create a digital credit instrument in Great British pounds or in Canadian or in euros or in, or in Swiss francs. So we create the currency we want, we put the appropriate amount of risk on it, we strip away the duration, and then we start selling pure yield. That is the compelling use case. And so are we on a mission? Yeah, we're on a mission. We're on a mission to basically give everybody a bank account that yields 10%, or in this case, a money market that yields 16.5% tax equivalent, right? We want to change people's view toward money, change their view toward credit, and it's not very complicated to figure out why you might want to do it. And I don't think it'll be complicated for people to figure out why they might want to own these instruments. Next slide. So let me just end with an observation. We're in the business of creating digital equity by harnessing digital capital and using the digital capital to create digital credit instruments. So the equity, MSTR, is digital equity. If you want amplified BTC because you kind of want enhanced exposure to digital capital and you want exposure to digital credit, then you would buy the equity. The price you'll pay is 62 vol. It'll be very volatile. Now, the next option you have is Bitcoin. And so let's look at that. If what you want is to strip away the counterparty risk and the currency risk, right? And you want a long-term store of value, you don't buy the equity, you buy BTC, and that's 42 vol. Now, what if you want a mixture of upside and quarterly income? You would buy Strike, 28 vol. If you just want to maximize your cash flows, then you would buy STRD, 16 vol. And if your idea is you want the highest seniority and the greatest degree of investor protection, then you would go to Strife and you get a lower vol, 14 vol. And then the final option, of course, is if you're looking for stability, simplicity, and minimal volatility, you go to a treasury credit instrument, which is STRC, Stretch. And when you put all these things on the same chart, I think it becomes pretty clear what we're doing and why we're doing it. And every one of these instruments is aimed at a different type of investor. We couldn't create the credit without the equity and without the capital. And of course, they're all reflexive, right? The more credit we sell, the better it is for BTC and for the equity. And, and as the equity appreciates, that's good for the credit and that's good for BTC. And as Bitcoin appreciates, that's good for the credit, that's good for the equity. So it's a very elegant business. We're very blessed, and we feel honored to have the opportunity, and couldn't be more excited about it. Let's go to the next slide. So what I would say here is, if you're not sure what you want, and you've listened to me so far, then you want Stretch, right? For those people that aren't sure what they think about Bitcoin or how they feel about the company or digital credit or anything, right? The simplest idea is 10.5% dividends paid monthly for those who like money. It's just that simple. You like money, you trust the company, but you don't understand anything else. You collect 10.5% dividends. They're tax deferred. They're paid monthly. Tell your friends. And I'll just end with our last slide, which is our principles that I want to remind everybody. Our principles are to buy Bitcoin, hold Bitcoin, treat all our investors with respect, prioritize the equity, generate positive yield, innovate with fixed income securities, maintain a healthy, robust balance sheet, promote global adoption of BTC as a treasury reserve asset. And I want to thank everybody for your time and also for your support. We couldn't do it without you. Thank you.
Thank you, Michael. We are now going to proceed to the interactive live Q&A session of our webinar. I would like to invite all of our Q&A guests to come on video.